Every empire collapses the same way. Not because it runs out of money, because money stops moving. Rome had gold, Spain had silver, Britain had banks, Japan had zero rates and unlimited liquidity. And every time, the same thing happened. The economy didn't explode, it froze. People still had money, government still spent, central banks still intervened, but nothing moved. Wages stalled, investment vanished, risk disappeared, growth went flat. Not for months, but for decades. And here's the part most people don't understand. By the time this freeze becomes visible, it's already irreversible. Right now, the United States is exhibiting the exact same symptoms. Not warning signs, not early indicators, the condition itself. And once money stops moving, power follows it. Slowly at first, then all at once. Picture a Roman merchant in the year 250. He's holding a silver denarius, freshly minted, stamped with the emperor's face. Notices it's lighter than the coins his father saved. Those old coins, 90% pure silver, they're gone now. Hidden, buried, smuggled out. What circulates instead are these new blanks, debased down to almost nothing. The empire keeps minting more, but no one wants to let go of anything valuable. So the good money vanishes, and the bad money pools everywhere, moving slower, buying less, trusted by no one. The merchant does what anyone would do. He hoards. He hides his best coins. He transacts in kind, grain for oil, cloth for labor, and only uses the worthless coinage when forced. The emperor mints more to make up the shortfall. The cycle tightens. Trade over long distances becomes unprofitable. The economy doesn't explode, it just freezes, region by region, as people retreat into subsistence and barter. That merchant made a rational choice, and so did everyone else, and together, those rational choices strangled the circulation of the empire. Now move forward 300 years. Spain is drowning in silver. The mines of Potosi and Zacatecas are pumping out more wealth than Europe has ever seen. Galleons crossing the Atlantic laden with bullion. The Spanish crown richer than any monarchy in history. And yet, Spain is dying. The silver arrives and prices explode. Wages can't keep up. Spanish-made goods become too expensive, and cheaper imports flood in from France, the Netherlands, England. The treasure ships that were supposed to make Spain invincible instead hollow it out. Domestic industries wither. Productivity collapses. And the worst part? Most of that silver never stays. It's pledged in advance to foreign creditors. Loans taken against future shipments to pay for wars that never end. The crown declares bankruptcy. Not once, not twice, but again and again across the 16th and 17th centuries. There's abundance everywhere and collapse anyway, because the money doesn't circulate through productive activity. It services debt. It flows outward. It lands in the hands of bankers in Genoa and Amsterdam, while Spanish farmers and craftsmen watch their economy unravel. Spain had wealth. What it didn't have was a reason to invest it domestically. And so it bled out, one treasure fleet at a time, rich and ruined simultaneously. This isn't history. This is the blueprint. Britain tried something else. In 1925, they returned to gold, the pound at its pre-war value. Prestigious, respected, completely unsustainable. British prices were higher than before the war, costs inflated, but the exchange rate was fixed as if nothing had changed. To defend the gold peg, the Bank of England had to keep money tight. Interest rates up, deflation grinding through the economy, unemployment spiking, factories idle, exports collapsing because British goods were too expensive. And for what? To preserve the appearance of strength, the ritual of gold standard respectability. Liquidity was there. Banks had reserves. But lending contracted because the entire system was bent toward defending an external anchor that crushed internal demand. Wages couldn't fall fast enough. Businesses couldn't adjust. The gold standard, designed to stabilize, became a noose. Every country that abandoned gold early recovered faster. Britain held on, and the cost was a decade of stagnation, eroded industry, and exhausted credibility. The money wasn't working because the rules wouldn't let it. We are not approaching this. We are inside it. The 1980s bubble, land prices in Tokyo so high that the grounds of the Imperial Palace were theoretically worth more than all of California. Equity markets vertical. Speculation as national pastime. And then, 1990, the bubble bursts. Asset values collapse. Banks holding loans backed by real estate that's suddenly worth a fraction of the debt. Corporations over-leveraged. Balance sheets destroyed. The Bank of Japan cuts rates, cuts them again, all the way to zero. They hold them there for years, then decades. They expand the money supply, print, buy bonds, buy equities, inject liquidity everywhere, and nothing happens. GDP stagnates. Inflation stays near zero or dips into deflation. Velocity of money, the rate at which money changes hands, plummets. Corporations stop borrowing. Households stop spending. Not because they can't, because they're terrified. Debt becomes the enemy. Cash becomes the refuge. Banks, burdened with bad loans and regulatory scrutiny, stop making new risky bets. Japan flooded the system with money, and the money just sat there, piling up in reserves, hoarded. The mechanism was broken, not because there was a shortage, but because no one wanted to move. Richard Koo called it a balance sheet recession. The private sector, scarred by collapse, focused entirely on survival, paying down debt, rebuilding net worth, avoiding risk. Rational behavior, individually sensible, collectively catastrophic. Japan has been trapped for over 30 years. Not chaos, not collapse, something worse, stasis, an economy that can't die and can't grow. Abundant money frozen in place. Everything you're watching now has already happened before. See the pattern yet? In Rome, debasement and hoarding. In Spain, bullion inflows and capital flight. In Britain, gold rigidity and deflation. In Japan, zero rates and balance sheet paralysis. Different mechanisms, same result. The money stops moving. Circulation dies. And once it stops, every attempt to restart it just reveals how stuck the system is. It's not a liquidity crisis. Those are acute. Those are solved by lending, by printing, by short-term interventions. This is a liquidity trap. The crisis is chronic. The fear is structural. Pouring in more money doesn't create more spending, more investment, more velocity. It just pools in bank reserves, in corporate cash hoards, in sovereign bonds yielding nothing. Because the agents in the system, people, businesses, banks, see the same thing. Uncertainty, risk, fragility. And the rational response to that is to hold tight, wait, preserve, hoard. The central bank can create money. It cannot create the desire to spend it. This is where we are now. After 2008, the Federal Reserve, the European Central Bank, the Bank of Japan, they all did what they were supposed to do. Rates to zero, then below. Quantitative easing, trillions in asset purchases. The monetary base in the US increased something like fivefold in under a decade. And inflation barely moved. Velocity collapsed. This is Rome's hoarding problem, but with digital dollars. The money lands in financial markets. Stocks soar. Real estate booms in certain cities. But business investment stays weak. Wage growth anemic. Productivity growth slower than historical trends. The money isn't circulating into the real economy. It's circulating into assets, bidding up prices for things people already own. Good money, real productive investment, vanishes. Bad money, financialized speculation, pools everywhere. Then 2020, another shock. More printing, more fiscal expansion. This time inflation did show up briefly because supply chains shattered. But look closer. Velocity is still depressed. Corporate cash holdings remain elevated. Public debt ratios have exploded. US, Europe, Japan, all pushing or exceeding 100% of GDP. This is Spain's capital flight with treasuries. The money doesn't stay domestic. It services debt. It flows into safe assets. U.S. debt is pledged forward to foreign creditors, to entitlement programs, to interest payments that compound. The system bleeds liquidity outward even as it creates more, because none of it lands in productive circulation. And now we're locked. This is Japan's balance sheet paralysis at global scale. The system is addicted to low rates and continuous support. Every attempt to raise rates even modestly triggers financial stress. Banks wobble. Bond markets seize. The withdrawal is worse than the drug. Look at a household. Wages flat for decades in real terms. Housing unaffordable. Healthcare. Costs rising. Student debt ballooning. So what do? They save when they can. They hold cash. They avoid risk. They delay spending. Not irrational. Terrified. Look at a business. Demand uncertain. Profit margins maintained not by growth, but by cost cutting, automation, financial engineering, buybacks, dividends, mergers. Why invest in a new factory when you can buy back your own stock and juice your price? Investment becomes risk. Risk becomes the enemy. Look at a bank. Post-2008 regulations force higher capital buffers. So you hold treasuries. You hold reserves at the central bank. You lend to the safest, largest borrowers. Small business lending? Risky? Startups? Too volatile. The banks have liquidity. They're just not transmitting it where growth happens. Same dynamic, different scale. The system is optimizing for safety in a way that guarantees stagnation. Now here's where people push back. But the US prints the global reserve currency. We can always just issue more debt, and the world has to buy it. True. Until the world stops believing that's sustainable. The dollar's reserve status isn't a law of physics. It's a convention backed by trust, depth of markets, and geopolitical dominance. Those things erode slowly, then quickly. And the reserve currency advantage means you can run imbalances longer. Not that you can run them forever. Rome debased its currency while it was the only game in town. Spain had a monopoly on New World silver. It didn't save them. Privilege delays consequences. It doesn't erase them. But markets always recover. Crashes are buying opportunities. Stocks always go up long term. They do, until the currency they're priced in loses meaning, or until the system they depend on stops functioning. Japan's Nikkei took over 30 years to return to its 1989 peak. If you bought at the top, you waited a generation. Stocks always recover is a statement about the past. It's not a law about the future. And in a liquidity trap, asset prices can stay elevated even as real activity decays because the money has nowhere else to go. You're not investing, you're hiding. But technology changes everything. AI, automation, productivity explosions, these will grow us out of the trap. Maybe, or maybe technology accelerates the problem. Automation concentrates returns in fewer hands, reduces labor share of income, and creates more precarious work. That increases inequality, reduces aggregate demand, and pushes more people toward precautionary saving. Productivity gains matter if they're broadly shared. If they accrue to a narrow slice, they just amplify the same dynamic. Wealth pooling at the top, velocity dying, demand shrinking. Technology is a tool. The structure determines how it's used. So what do? You can't fix the system. You can see it clearly and position accordingly. Recognize that nominal wealth is not real wealth. If your net worth is tied up in financial assets, priced in a currency, manage to avoid deflation at all costs. You're holding a claim on a frozen system. Diversify into productive real assets. Skills, land, tools, necessities. Reduce leverage. Debt is a bet on future income and future liquidity. In a liquidity trap, both become uncertain. Being debt-free means you're not forced to sell, not forced to move. You can wait, build optionality. Liquidity traps, lock systems. You need to remain unlocked. Skills that travel, income sources that aren't geography dependent, social networks that provide non-market reciprocity. When formal systems freeze, informal networks survive. Understand that inflation and deflation happen simultaneously in different sectors. Housing, healthcare, education, inflating because of policy distortions. Goods, wages in non-protected sectors, stagnant or deflating. The aggregate numbers mask divergence. Position accordingly. Accept that systemic solutions are political, and political systems in late empire phases do not produce systemic solutions. They produce blame shifting and policies that protect incumbents. If you're waiting for a policy fix, you're waiting for something that won't come until after the consequences are undeniable. By then, the trap has already closed. None of this is advice to get rich. This is advice to stay solvent while the trajectory plays out. Because here's what's true. We're not at the beginning of this. We are deep into it. The velocity of money has been falling for over a decade. Public debt is at wartime levels without a war to end. Monetary policy is exhausted. Fiscal policy is constrained by debt burdens and political gridlock. The productive base is financialized. The population is aging. The geopolitical order is fragmenting. And every response to every shock just adds more weight to a system that's already too heavy to move. The liquidity trap doesn't announce itself. It just tightens, imperceptibly at first. A little less growth, a little more debt, a little more caution. And then one day you realize the motion has stopped, the room is closed, and the options that existed 5 years ago, 10 years ago, don't exist anymore. Rome didn't collapse in a day. It bled for centuries. Spain declared bankruptcy 9 times over 150 years. Britain's imperial decline took half a century to become undeniable. Japan has been trapped since 1990 and still hasn't collapsed. It's just become a warning no one heeds. The trap is patient, and it's already here. You can see it if you stop pretending growth is coming back. If you stop believing policy will save you. If you stop treating the market as a machine that runs on its own logic. It runs on fear. And right now, fear is winning. The empires that came before didn't understand what was happening until it was too late. They kept trusting the old rules, debase and tax, import silver and borrow, defend gold and deflate, print money and wait. None of it worked, because none of it addressed the core mechanism. When circulation stops, the empire is already over. It just doesn't know it yet. We know it now, or we should. The question isn't whether the trap is real. The question is whether you're ready to live inside it. If this resonates, if you see the shape of what's coming, hit subscribe. This isn't a channel, it's a watchtower, and the view from here only gets darker. The money has stopped moving. Now we find out what happens next.